Assalamualaikum warahmatullah. Everybody, welcome back to our program. Yesterday we were talking about the setting up of profit rate based on interest rate. So to benchmark profit rate against interest rate is all right in view of the fact that the risk faced by Islamic bank are similar to the risk faced by conventional banking. And therefore, the pricing of the Islamic product can be similar to the pricing of conventional product because of the risk attributes of this product are quite similar. And so I was also saying that if the murabaha or the tawru is to incorporate ownership risk in their transaction, then the risk profiling now will be much different, and therefore it would be inaccurate to use interest rate, as a benchmark to set profit rates, as when we see an additional risk imputed into the murabaha, then the risk would be much higher, and therefore the return to the murabaha should also be much higher based on the additional risk that is taken up by the murabaha. So overall, if we look at the component of interest rate, whereby the profit rate is using as a modality, we can see here that interest rate, the component of which are the cost of deposit, overhead, and the spread. And the spread is basically the additional interest rate on loan based on the credit standing of the borrowing customer. So one component of the interest rate is the spread or the risk premium that is coming from credit market and operational risk. But usually in debt financing, the major risk is coming from credit risk, and therefore the spread is sometimes called the credit risk premium, even though to some extent market and operational risk premium are also added on, but these are much or very marginal compared with the spread arising from default. So the spread is the additional interest rate on loan based on the credit standing of the borrower. But when we look at the loan rate or the interest rate the bank is charging the borrowing customer, we can look at it from two components. There are two main components of interest rate. Number one will be the cost component, which is the deposit rate. The bank mobilize deposit in order to make loan, and the bank pay the depositor a certain deposit rate, say 2-3%. And then the bank will have to pay for the overhead expenditure. So that is also a cost to the bank. So that will be the cost of fund as well. And then the cost of keeping up with the statutory reserve requirement and liquidity requirement, so that need to be incorporated into the cost component of the interest rate. And this is where, for example, if there is an increase in the OPR, then that increase will be affecting the cost component of the interest rate, which is the deposit rate. 3-month FD rate, can be quite similar to the interbank money market rate or the OPR, and either way, bank can use both rate, as their base rate, and therefore any increment in the OPR or CLIBOR, or in the international scene LIBOR, then the deposit rate will go up and the loan rate will also go up. The second component of interest rate is the risk component. And this is basically the risk that is covering the cost of default. And therefore, the bank will always add an additional interest rate, as a charge on this credit risk. So this is when if our credit standing is good, then the interest rate on the loan will be much lower compared if the credit standing of the customer is bad, then the loan rate will be much higher, right? So in a sense that what the bank will be making in their business will be based on the risk component of the interest rate, because the more risky the customer, the more the bank will charge, and the higher will be the interest margin. And the less risky the customer, because maybe the customer have asset and collateral, and therefore the interest rate will be much lower, and therefore bank will make less interest margin on this facility, but then the facility is less exposed to the danger of default. So as I said, the benchmarking of interest rate by the Islamic Bank will affect the cost of deposit, but overall, the overall pricing model of Murabaha and Tawarruk actually follow the pricing model of interest rate bearing loan, where the profit margin is based on the riskiness of the borrower. Yes, so it is, that meaning that if the Islamic Bank is taking more risky borrower, then the loan rate will be much higher, the profit rate will be much higher based on the lower credit standing of the customer. Conventional bank, if they were to take in a stronger or higher credit quality customer, then they will be charging lower interest rate on the facility. So it depends on how the Islamic bank or the conventional bank is looking at the prospect of taking in customer, and we should look at the risk appetite of the bank, to what extent they are willing to take in risky customer or less risky customer, based on the amount of capital, or it is based on the capital adequacy requirement that will determine how much risk that these banks are able to resist in the business of making loans and murabaha. Okay, thank you very much. I think that will be it for now. I think we can continue later to further look into this issue of the profit margin in Islamic banking. Thank you very much. Assalamualaikum warahmatullah.